You are listening to Keystone's Stock Talk Show, episode 178. If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook. And keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold. Back from the Big Smoke, the center of the Canadian universe, Hogtown, the city of many nicknames, or as Brennan, a huge Drake fan, refers to it, the Six. For the majority of our listeners who are still likely unaware of what city I'm actually referring to, myself and Aaron just returned from Toronto, where we spoke to audiences at The Money Show, the first time in person for over 3 years. We'll get into our talk and the highlights of the event, including my take on the folly of macro forecasts. We have a big stock debate for you this week as the Killer Bees, Brennan and Brett, square off in a no-holds-barred battle. In the crosshairs this week is a company founded in Brennan's current stomping grounds, a city previously thought to be made up. Yes, Saskatoon, Saskatchewan. The company Vecima Networks Inc., VCM on the TSX, develops hardware and software solutions for broadband access, content delivery, and telematics. The coin flip chose Brennan for the bear case and Brett as the bull. Aaron sits in as judge, jury, and executioner. In light of recent interest rate hikes and the continued likelihood of more on the horizon, Aaron takes a brief look at the fixed income markets, bonds, GICs, T-bills, and a preview of some work he will be presenting at our fall 2022 upcoming seminars. So let's get to the show. Let me welcome my co-hosts, Aaron, the Killer Bees, Brennan, and Brett. How are you guys doing?
Doing well. Salutations. How was your guys' trip?
It's great, actually.
It was good.
I mean, we're, aside from the fact that I had to spend 2 days with Ryan, it was quite a worthwhile.
Yeah. Thank God not in the same room, right? So.
No. Actually, Ryan went out a day before me, so he was there a little bit longer. But
I'm just
Ryan,
in a little more demand than Aaron is.
You did a panel the first day. For anybody who doesn't know, we were at the Money Show. This is in Toronto. This is the first in-person event that the Money Show has done since the start of the pandemic. It's the first time I've spoken in front of a live audience since the start of the pandemic. So it was exciting, but we had a good crowd. I didn't make Ryan's. I wasn't able to see Ryan's panel. He was on a panel with a few other people on the first day.
I think there was about 350 people for that, so it's pretty good. For the room. It was a good panel, quick and dirty, in and out. Talked about a couple stocks. They asked us to make macro forecasts, and I politely declined, or less politely declined. I'm kidding, but we just I'll talk about why we don't tend to make a ton of macro forecasts, but we talked about some individual companies and what we should focus on in the market right now. So it was good.
Anybody else make macro forecasts?
Throughout the conference, I'll talk about that. I sat down on a couple, and I mean that's what the financial industry does, right? Makes forecasts.
How about on your panel?
It was more trying to find value in individual securities within the current environment, within like a bear market environment. So there wasn't a ton, people, there's a little bit on where they thought interest rates would be going, but most of that is just extrapolation of what is going on right now, right? So I mean,
so nobody we can make fun of on the podcast, or
lots. I mean, I don't know if we want to name specific names.
Ryan prefers to do this from his alternative Twitter account, so not.
Yes.
His burner
the dummy, the burner Twitter
like
account,
the rest of the internet,
we rip
right?
everybody in the industry.
Good.
It's true.
And then Ryan and I spoke on the last day on the Saturday, and it was great. It was a great room. We had a pretty full room, which was nice to see. Nice to speak in front of a full room. Ryan talked about some small caps, gave a couple specific names, made fun of our beloved prime minister a little bit, which is pretty typical. If anybody's seen one of Ryan's speeches. I talked about the SaaS research,
It's
the
low-lying
software
fruit. It's
technology.
pretty easy.
It's pretty easy. I know. It's just it gets a little too easy. Although I do have that photo of you that I showed at the World Outlook with you shaking hands with Trudeau. So I'm gonna have to expose.
I did have one of those buzzers in my hand, though. I had one of those buzzers.
Yeah,
so,
that's what we didn't see is the electric
a
shock.
high-grade shock buzzer. So it may contribute to.
I talked about the software industry in the U.S., which is down, about 24% overall. But we were showing that some of the big names in the space are down 80%, even as far as 90%, like the Zooms, the Palantirs. There's a couple other names that I had on there as well. And then you gave some recommendations from that. Also, we talked about dividend growth stocks. Are they still appropriate in the current environment? So people stuck around for
I think that was the great part. We spoke for 45 minutes, and yet we literally closed down the event. Like 90% of the room stayed for an hour and 15 after to chat with us, go over the markets, look at individual securities, stocks that they had in their portfolio. I mean, like some of the common questions we got were on like companies like Shopify and Lightspeed, which, because Aaron had Shopify in his presentation. I think it's 82% either from the highs in November or year to date.
Just to clarify.
No, not as a recommendation. No. I mean, like it
as a cautionary tale.
Yeah, Shopify, tremendous revenue growth. Tremendous revenue growth. It just has never met our criteria during this whole period because the underlying fundamentals, the cash flow, and the multiple you were being asked to pay off that was too high. And so, we talk about this all the time. Price is what you pay, value is what you get. And we were never getting anything close to value in Shopify. And the astonishing part is, so that you get from the audience, with it down 82%, is it not now? It must be a screaming buy. It must be screaming value in my portfolio. And, Aaron just ran through the numbers looking forward in terms of earnings or cash flow on the business. And, it's just under 100 times still that you're asked to pay for that business, which now is experiencing a little bit of a revenue decline and also margin compression this year as they're, competing with Amazon on same-day delivery. And, it's a great goal to have, and it may be something they're able to achieve. We think it's a great product and service that they offer to their end clientele, but has the value ever been there to come into our universe where we like growth at a reasonable price? No, it hasn't been there, and we continue to, we'll continue to monitor Shopify, but it's not going to be a buy for our clients in our portfolios. Similar can be same with Lightspeed. Tremendous revenue growth, roll-up story, has a ton of cash in the bank relative to its market cap, but it's just forecasting adjusted EBITDA positive, on a forward basis. It's price to sales, while the stock is absolutely plummeted, is still, and it's not the price to sales, it's really the price to cash flow that we're looking at. It's not there. It's not value in the market right now. And we look to other companies, some, that we put into our SaaS report that we recently put out that actually have growth in underlying cash flow and trade at, relatively reasonable valuations. Although, Aaron talked about this in his presentation, have the valuations swung back to where we think there's screaming buys in SaaS or technology in the US? No, not yet. They haven't gone to there. They're fair to, they've come back to the average of maybe the last 10 years. So that does not scream a buy to us. And there's some individual situations we're looking at, but we're not at the point where we're saying screaming buys in that sector yet. So did we want to discuss a couple articles or one article that we saw this week? And then I'll get into a little bit more about, I was reading a memo, Howard Marks's memo on the way back, and we can get into that after we look at this. Yeah, I mean, this was interesting. It's an article from Bloomberg. Congress, there's a proposal for a Congress stock trading app. Essentially, the symbols are NAC and it's Cruz, so probably Nancy Pelosi and Ted Cruz, I believe. Basically. So essentially a pair of exchange-traded funds that would mirror the personal portfolios of members of Congress. It may be coming soon. The fund would be constructed of this is in the filings, 500 and 600 companies. So they'd be called the Usual Whale Subversion Democratic ETF under Nance. And then the Unusual Yeah, is it or the usual? Yes, so it's the usual.
Yeah, they're
Wales
both
Suburban
unusual.
Republican. Yes.
Yeah,
yes,
like
they
that's
are.
their company branding. Yeah.
Yes, I get it. Okay, now I would say financial industry, kudos, you've done it again. Like, let's not try to create great investment vehicles or strategies based on tools that historically achieve success or have some kind of reasonable, testable, novel concept that should work. Let's place clients in investments that genuinely that we believe will create wealth for the long term. Hell no, let's not do that. That sounds boring. Instead, let's slap together a headline-grabbing marketing vehicle that is half-baked and based on the hope that Congress are basically all corrupt and or great investors. Well, one could argue for the first. The second is not true. And to me, it seems ironic that the same investors that will probably flock to an ETF like that are the same ones that call Congress morons on a daily basis. But apparently they assume they are all legendary investors. So even if this holds true, do any of you truly believe that Congress holds all the power and levers to ultimately make any stock they choose hugely successful? Yes, Congress decisions they have to be the only factor one should choose in making their investment models. Not the quality of companies' management. It's effing products or services, the company's valuations, its growth prospects, interest rates, etc., etc., etc. These, I'm going to say, are crap vehicles designed to grab headlines and draw investors to the fund companies. In fact, they should actually do the opposite. I will go on to say, again, we said the disclosure in this fund says it'll have between 5 and 600 holdings. With that many stocks, it'll basically track the index. You can have, and we talk about this all the time, you can have a well-diversified portfolio with 20 to 25 stocks. The exercise of this fund, to me, is ridiculous. Finally, to top it off, they're charging 1% fee for an exercise which needs little research, zero original thought, and could basically be run by the average hamster. In fact, I predict over the long term, a hamster invested in the S&P 500 will beat this ETF. And that's all I have to say about that.
Yeah.
Tell me your opinion.
There's a
Tell me how you
prediction. We
feel.
make annual predictions, so maybe we should take a look at this in a year and see how it performs.
Yeah, if it even gets listing.
Yeah,
Maybe it was just done for headlines. Even if it gets...
And that is like an interesting case. Maybe it was just for headlines, because I was reading an article where last week on Wednesday, the Democrats, Nancy Pelosi, said that they would bring legislation to the House floor this month that would place new restrictions on the ability of lawmakers to buy and sell stocks. And then they say a version of a legislative framework in the House outlined in a late August memo that was reviewed by the New York Times would effectively prohibit lawmakers, their spouses, and dependent children from making trades in individual stocks, bonds, crypto, and other financial assets tied to specific companies, but they could essentially invest in mutual funds and ETFs still. So,
which would be fine, because I mean, a mutual fund and ETF or an ETF is going to have a very wide net, so they're any type of insider trading or knowledge isn't going to be relevant. I suppose the exception could be if you're talking about an industry ETF. Mm-hmm. Maybe one of the politicians would have some information specific about an industry or legislation was going to be passed, either benefit or negatively impact an industry. So that I suppose there could still be some, but. In that case, like there was discussion and much discussion on Twitter and Reddit about Nancy Pelosi's, and it was ahead of the funding for the semiconductor industry essentially, and holding securities like Nvidia that could possibly benefit from that. Ahead of that, and it's happened in many times. I mean, there's a Twitted. I just combined Reddit and Twitter. That's impressive. There's a Twitter account that basically tracks all of her trades and her husband's trades, and it has like 164,000 followers. So I mean, you put this ETF, that gets on that. You got 165,000 potentially people that are watching that. I mean, you get a lot of press, but I mean, I would just hope we could do better in the financial industry. There's a ton of crazy, stupid, to be honest, ETFs that track ridiculous things in the market that really aren't designed in an effort to, really provide great returns over the long term for clients. They're designed to grab headlines for the fund or the ETF company, in my opinion.
Yeah, and when you initially
and they'll get investors investing in them, but that's That's an indictment of the investors who are putting their money behind these things.
Yeah. When you initially brought this up to me, I thought that we were like going to be talking about like 40 to 50 to 60 stocks in this ETF or something, not 500 to 600 holdings.
I mean, there's so many things that you can rip apart this type of ETF that it's just on so many different levels that make it ridiculous. And charging the 1% fee to me is insane too. Like it just, anyways, we could go on and on about that, but. Is there any other headlines we want to discuss today?
Well, before we move on, there is one other statement that I would like to make about these ETFs, and that's that if they're going to be tracking the public disclosures of members of commerce to make their investment decisions, one thing that investors also have to keep in mind is that there's going to be a lag period between when a position potentially is held in a portfolio and when it's disclosed. So it's not going to be an immediate disclosure. I mean, you're typically going to be I don't know
it's
the
45 days.
Time. 45 days.
Yeah.
Right. Okay. So you're talking about 6 weeks between disclosures. So you're always going to be a little bit behind. That means that, some of these ETFs could be buying securities while these members of commerce are actually selling them, or if they are actually trading on short-term inside information, the benefit of owning the security may have already passed, may have already moved up in price before the ETF, the public disclosure is out, and the ETF has the opportunity to buy it. So you're always going to be trailing. There's always going to be a trailing time period here, and so to me, that's fraught with complication, but just something to keep in mind.
For sure.
Yeah, and we're not here to say like naively that there hasn't been in the history of a member of Congress or a member of Parliament somewhere in the world that has benefited from insider trading transactions. Like it has happened, it will happen. Is there a fund that can actually track that and benefit from it? And the structure of this fund, like even if you held that as a constant, that this was happening all the time, it just doesn't seem like it would at all be able to benefit from that type of information or any type of trading strategy that's going on. It just seems extremely gimmicky and kind of raises my blood because I see this a lot in the industry, and it becomes farcical when there should be it should be the goal of the industry to be going out there and creating a product or just doing a ton of research to find companies that can create wealth for investors over the long term, not something that create headlines.
Yeah, and this isn't the first time that we've brought up an ETF like this. Remember we were talking about Dave Portnoy's VanEck Social Sentiment ETF, the ticker symbol BUZZ, Buzz, which like follows the most talked about stocks.
We should track how that's done over the.
Well, it's down. It's down 40%, but yeah, we should look at its holdings and whatnot. But it is down 40% since it started trading. But
we could maybe do a deep dive on that. Maybe one or two other ETFs.
The only thing is, it would be more for it'd be really just for showing the folly in it. I mean, which again can have some value for sure. But I mean, not surprised to see a fund like that down 40% since inception. Now, I was doing some reading on one of Howard Marks's memos. We talked about Howard Marks on a previous show. I think you can go back and see the information we had on him kind of as a legendary investor. I was reading one of his memos on the flight home from the Money Show in Toronto. Now, I found the subject matter, which basically amounts to the futility of macro forecasts. It spoke to me. We had both just attended financial conferences at which economists and investors made a multitude of economic and specific market-related macro forecasts. It was one of the first in-person events that I had attended in quite some time, and many of the talks opened by highlighting the abnormalities experienced over the past 2+ years. At one of the presentations that I had attended, the host spoke about how crazy the economic environment had been since the start of 2020. We experienced a totally unpredictable global pandemic, unprecedented government handouts and resulting debt increases, a massive spike in inflation, rapid rate increases, the rise and volatility of digital assets, and the war in Ukraine were just some of the events cited. Throwing his hands into the heavens, he stated that even the Almighty would have had a hard time predicting all these basically unpredictable events. The panelists, as well as the crowd, had a huge laugh. what I assume could only be a combined chuckle designed to let everyone off the hook for the macro forecast and subsequent investments based off those forecasts that these events had not only rendered useless, but it helped turn them into steaming dog turds in their portfolios. But then the chuckling died down and the presenter blissfully moved forward with a whole new set of bold macro forecasts. Immediately, the audience, and never fail, raised their iPhones to snap up each bold prediction about everything from where inflation will be in the next year to the direction of the housing market, the price of gold, Bitcoin, and where the US dollar will be in 2023. So the same people whose models were proven wrong were back at it, working hard, or in some cases hardly working, in my opinion, to provide the audience with a whole new set of macro predictions. And the same crowd which used those flawed macro forecasts to dismal results was eagerly lapping up the new macro forecast and laughing away the last several years. As I looked around the room, I found myself wondering how it appeared that most were missing the utter insanity of this. Now, they say the definition of insanity is repeating the same mistakes over and over without learning from our mistakes, recognizing what does not work from a probability perspective. We are doomed to continually make the same mistakes. But this is the engine of the financial industry at work. Macro forecasts provide the illusion of knowledge and control. If spoken with conviction by talented, intelligent professionals, they are calming and provide more importantly saleable. Now, if these macro forecasters went on stage and in most cases truthfully said, I don't have a reliable or actionable way of accurately predicting where inflation, interest rates, or the price of gold will be next month, in 1 year, or 5 years from now, you're less likely to buy their fund, ETF, or trading program. Investors are just as guilty for buying into the illusion of macro forecasts. These saleable lies the industry feeds investors, which most find comfort in, and the cycle continues. Now, I would submit that the fact that the list of events, the pandemic, government response, fast rate hikes, etc., was so extensive, does this not show the complete folly of macro forecasts? In fact, if they can just be derailed so simply by unpredictable events, which are quite frequent, they should be rendered useless. In his memo, Marx made another great example. I will quote or paraphrase from him here. So in the fall of 2016, there were two massive consensus macro forecasts. Number one, Hillary Clinton would win the election. Number two, somehow if Trump was elected, the markets would tank. So what actually happened? Trump won and the market soared. Should this not help convince investors of the complete lack of value in macro forecasts? Now, next week, I'm going to summarize Mark's arguments on the futility of macro forecasts, but I think that's enough for my sandbox speech here for today. Any comments on that, guys?
Well, I noticed that you said that that the speaker went on to make a number of different macroeconomic forecasts in all sorts of different areas, from gold, commodities, Bitcoin, interest rates, inflation. And that's actually a very common technique that forecasters will use, is that they will make a large number of predictions. They'll make those predictions publicly. And if you make enough predictions, eventually, just by the law of probability, one or two of those is going to come right eventually. And those are the ones that you're going to hear about next year at the conference, typically speaking, unless, you
it's a common
right. But the more predictions you make, the more likely it is that one of those are going to hit, just by pure luck of the draw. And that's really what a lot of forecasting is about. It's about making a lot of predictions and then focusing on the one or two that end up being correct or close to correct. So, but this does not provide any value whatsoever when it comes to making investment decisions. So if you're an investor and somebody's making a prediction on where interest rates are going to be, if they're 100% correct with the timing, with the magnitude of the change, there are actionable investment decisions you could make off of that. But at the same time, if they're making 10, 12 different predictions, well, how are you going to determine which prediction to follow and which investment decisions to make? It's virtually impossible. And then it just comes down to chance.
Yeah, part of what you said there is kind of the heart of Marx's theory on why they're basically unprofitable forecasts for a portfolio. So we can talk about that and get into that more next week. But you and I know, and probably all of you guys here know, that we've been at many speeches over the years that, you've seen 25 forecasts made, right? Like, and it's not actionable. And then next year, the two that actually came true by pure happenstance, by freak luck, are highlighted in a presentation. And it doesn't have a lot of value if you don't go back and look at every prediction was made and either go a check or an X beside them. And if you're going to do it, just you throw anything at a wall, something sticks after a while. There's an expression about that. Yeah.
And you may see me at one of those events also snapping photos of the predictions up on the screen. But
so
it's so I can make investment
decisions.
Year. Yeah. So I can come back next year and say, why are you wrong 99, 20 times?
Yeah. But yeah, you hit the nail on the head, Ryan. Just not actionable. The amount of times that like I've even been to conferences now and people talk about maybe some gloom and doom scenario and that's going to happen on this day or this month and nothing actionable from it. It's like, people come to these conferences for investment advice or idea generation. Something that's actionable that you can actually, make a move on in the market. But yeah, a lot of the time I see, just some ideas thrown out there and nothing that's actionable built on that idea.
Yeah, I mean, that's why I like to go to an event where it has, I want, here is 2 or 3 either commodities or stocks to buy. This is why. This is, making 20 predictions on everything from where the price of wheat and corn and gold and Bitcoin will be in a year, or it's just there's not either there's too much actionable or it's too broad that it's not an actionable event that you can actually profit from. And I mean, that's what we're trying to do. That's why when we do a speech, we'll give 1 or 2 or 3 individual recommendations that can actually go back on in a year, 2 years, and look to see if we are correct in those areas. So, And again, we don't want you buying just 1 or 2 stocks. I mean, that's even if we've done all the research, this is what we talked about too: 15 to 25 stocks, build that over a 12 to 24 month period. So taking just one recommendation from anyone is not a good practice as well too. So, all right, Aaron, should we get into your as you've got an issue with your you could be losing your computer, your juice here. So let's get into yours. Then we've got a debate, a much anticipated debate between Brennan and Brett on Vecima Networks. But let's get to your, you're gonna look at a little bit at the fixed income market, correct?
Sure. So I just wanted to just let everybody know a little bit about what we're doing in the current environment. So as in the past, like just from the perspective of fixed income for a lot of the last decade has not been an area where you're going to generate much of a positive income return, right? So when I say fixed income, I'm talking bonds, GICs, which is essentially debt. You're essentially buying debt from the government or from a bank or from a company. And just like with a bond, you're getting a regular coupon payment, which the debtor who you buy it from is legally obligated to make. Usually it's every 6 months. There's going to be a coupon payment and interest payment. And then your principal, 100% of it is returned at the end of the maturity date, which could be 1, 2, 3, 4, 5 years or 10 years or longer. But things with the way that interest rates have trended over the past 6 months, things have changed somewhat in the fixed income market. So I think it makes a lot of sense for investors, for our clients, that we take a look and reassess how fixed income can fit into an investor's portfolio. We talked about this a little bit at the conference, but I'm really doing a deep dive over the next couple of weeks here. And we're going to put out our fixed income investing report that basically gives people a roadmap for understanding the fixed income investment class, and then implementing a fixed income strategy, which means essentially determining, well, one, whether or not fixed income is an appropriate investor or investment for that individual, understanding what some of the risks and opportunities are, and then looking at what are the practical steps of actually purchasing fixed income securities in your portfolio. So it's pretty interesting because if I were to look at, say, GICs a year ago, you essentially were getting no return, like in many cases 1%. I think at some points even less. But nowadays, when you look at GICs, a lot of them are paying 4.5%, even starting to push up to 5%. Now, GICs, they come in different forms. So I think it's important that people understand what's available. I mean, you can, typically when you get a traditional conventional GIC, one of the things that investors need to know is that your money is locked in. You can't sell it like you can with a bond. You can't redeem it early, or, potentially you can, but with a lot of fees involved in that really make it not worthwhile. But there are different types of GICs. For example, there's a cashable GIC where you can redeem it, but you're of course going to get a lower interest rate. So those aren't paying 4 or 5%. So understanding what types of products are out there for people, comparing, like, say, a GIC to a bond. If you're implementing a fixed income strategy, a lot of people will say, well, do I just buy GICs? Do I buy individual bonds? Do I buy a bond ETF? So we'll be exploring a lot of that, and just really understanding. So I'll just as an example, this here is the BMO aggregate bond ETF. This is ZAG. So this is just like your typical diversified, primarily Government of Canada bond ETF. ZAG is the symbol. So they would own a portfolio of different bonds that are diversified by maturity date. In some cases, diversified by issuer. Most of it's going to be Government of Canada. Some of them are going to be AAA or AA corporate bonds, or just investment grade corporate bonds. But there's a lot of information here. You have your weighted average coupon, you have your annualized distribution yield, your weighted yield to maturity. So if somebody's looking at this, how do you determine like what type of income you're actually going to get from this bond? So from this bond ETF. So just essentially looking through a couple of these, giving some examples of how people can purchase a portfolio of bonds and fixed income, and determining like what type of asset allocation is going to be appropriate in certain cases. And a lot of cases, like, people will not need to have any fixed income necessarily, but a lot of people should probably look at purchasing some type of fixed income allocation. Now, another question that I really want to dive into as well, and we've heard this, is in an era of rising interest rates or higher interest rates, does it still make sense to own dividend stocks or dividend growers? So I think that's also an important question to answer too. I've got it's really interesting. Let me share my screen again here. It's a really interesting report that I look at on an annual basis. It's from RBC Capital Markets. And what they do is they analyze the performance of dividend paying stocks and dividend growers over a long-term period. So if you can see here on my screen, dividend paying stocks have outperformed from 1986 to 2021. Dividend growers producing average annual returns, this is for the TSX, of 11.2%. Compare this to non-payers, so companies that don't pay any dividends, 1.4% average. So huge outperformance there, but also lower risk. Annualized volatility, which is a measure of risk, dividend growers 13.2%, a little over half the volatility or half the risk measured by volatility relative to non-payers. So this is I find this really interesting, and I think that even in an environment of rising interest rates or higher interest rates, dividend growth stocks still have a place in an investor's portfolio, because there's certain things that dividend growth does that a bond will not do. So for example, you might be able to get a 3.3% income yield off of a bond ETF right now. But that is those coupon payments that you get, they will never grow unless you buy a bond down the road that has a higher interest payment. But you get what you get with a bond, and it's essentially just a flat fixed coupon payment. But as your bonds mature and you're getting new bonds, if interest rates are going down, you may actually in 5 years be getting a lower income yield on your portfolio. Whereas with a dividend growth stock, one of the things that differentiates the income stream is that if you have a good dividend grower, that dividend is actually growing over time. So 5 years from now, 10 years from now, you're looking at a high likelihood of higher dividends than you're getting today. So we like that. We like that attribute of investing in dividend growth stocks. We like to be able to invest in companies that are growing as well, reinvesting a portion of their cash flow back into the business so that they can grow their earnings, so that they can grow their dividends over time. You're getting the potential of capital appreciation from a dividend growth stock, whereas you're not getting that from bonds. So while for some investors, having fixed income in their portfolio is a good idea, having a dividend growth component of your portfolio, we believe is absolutely vital for investment success long term. And if you look at the numbers that I showed you from RBC Capital Markets, you can see you really put yourself systemically at a disadvantage if you don't have an active dividend growth strategy in your portfolio. So how do you combine the two? How do you allocate capital to fixed income? What should you buy? How do you buy it? And then how does this relate to also your dividend equity strategy as well? So we're expecting the report to come out over the next couple of weeks here. And as we have more information, I'll share it on the show.
Yeah, thanks. It's a good summary. And like we've talked, to put it in cheesy terms, dividend growth stocks as a secret weapon in your portfolio, really. To outperform over the long term with less volatility, like those two things you don't typically see, right? Like to have less volatility and outperform over the long term, put those together. It's a great combination for your portfolio. That's why we look for dividend growth stocks in our income research and even in our small cap research, growth and companies that institute dividends. I mean, we had a couple companies in our small cap research increase their dividends this year, and one of them that we just picked up coverage on in December is implementing a dividend by year's end. It's a good thing to have these dividends, to be able to use some of your cash flow to distribute back to shareholders, but also then use part of it to continue to grow the company over time. A dividend often implements a discipline on management to know that each quarter they have to share some money, some of the pot with shareholders, and they tend to mind their cash flow better than companies that can have a quarter or two or even a year when they dip into negative cash flow. But if you always know that you have to pay something out, you tend to mind the cash flow statement a lot more, which we think adds to returns over the long term. So,
bull versus bear stock battle.
Now we're going to do our debate, correct? Aaron, you ready to be a judge?
Sure, I'm just going to set my timer up here.
Timer?
I'm ready to win.
Let me check my...
That's not how you're talking before the show.
That's not true.
So we're going to... Vecima is in the crosshairs. Do you have a summary on Vecima, either Brennan or Brett? Just what the company does, or...
I do. I can read.
You do? Okay, perfect. Go for it.
Yeah, so Vecima Networks, VCM on the TSX.
He's already ending it for you.
I think they trade around $17.75. And so essentially, Vecima provides technology solutions that empower network service providers and content providers to connect people and enterprises to information and entertainment worldwide. It offers products for the cable and broadcast industries, which provides video and broadband access to service providers, content creators, and broadcasters. The company operates through three segments: its video and broadband solutions, content delivery and storage, and telematics.
Okay, thanks for the summary. Are you ready to...
Shall I?
Are we know who's going first? Pardon?
You can go first if you want. I'll go first.
I'll go first. Going first is maybe hurting my record here, just with the recency effect. I don't know. We'll see.
Aren't we supposed to be flipping to see who goes first?
Sure, do it.
Well, I don't have a coin, so...
It's okay. Just let me go first.
The judge is prepared. He's really
okay,
prepared.
So you're going to go first. The brave man, Brennan.
I am.
Okay, you ready?
I am.
Go.
Vecima's financial momentum appears to be positive, with revenue up 60% year over year, but the company's historical growth has been a bit spotty, with a CAGR of just 5% from 2015 to 2021. And earnings have also jumped in and out of profitability, where over the last 12 quarters, the company had a median net income margin of just 2.5%. With these slim margins, the company trades at pricey multiples of over 60 times earnings and 16.5 times adjusted EBITDA. We used to love the company's cash-rich balance sheet, where from 2015 2015 to 2020, it held over $2 in net cash per share. But this beautiful net cash position recently slipped into a net debt position of 26 cents per share. Plus, its payout ratio for the first 9 months of the year is 73%, which is up from around 40% in 2017 and 2018 when we had a buy rating on the stock. Vecima is a quality business, but with its high valuations and spotty profitability, I think the stock remains a hold and is not growth at a reasonable price. Boom.
Okay, 4 seconds left.
Whoa. Anything else to add? You're done.
Okay. Hey, that was right to the point, right to the jugular. Okay, let's see what Brett can do. Are you ready, Brett?
I am ready.
Go.
Vecima has strong revenue growth of 60% year over year and strong net income growth of 36%. Even stronger adjusted EBITDA growth of 314%, and that does not have much share compensation. This is on the back of its Entra family of products, whose sales grew by 142% due to the rising switch to distributed access architecture, or DAA, across the globe. As well, the balance sheet is strong with $55 million in working capital and only $4.5 million in net debt, while being able to maintain a consistent dividend since 2014. Vecima technology enables upload speeds up to 6.2 gigabytes per second, which I'm sure Brennan would love, as it takes 2 hours to upload after the recording. Both the US and Canadian governments have financially supported the industry with $20.4 billion and $2.75 billion in funding to support expansion of internet access, which requires products Vecima makes to succeed. You may say competitors will be able to compete, but Vecima has a backlog of research to support its products with $350 million in R&D in the past 7 years. The great products have resulted in 45 customers ordering from 6 continents, up from 33 in the prior year.
2 seconds left.
Wow, talk about going for the jugular.
Well, Brett had a lot to say. You were going at rapid speed there.
Yeah, he was chirping the Saskatchewan copper in that out
So
there.
so they actually put out, Vecima actually put out a news release yesterday about its products being in 8 of the top 12 cable operator companies. What do you guys think of that? Any last minute comments on that? Anything?
I don't think I need to make my case any further.
So in other words, it's my case here. And that is continuing them acquiring customers. They have great global coverage. If you look at, I wish I'll put it up on the screen afterwards, but we won't be able to see it. They essentially control all of North and South America, and then a bit of Europe, if I remember correctly, and a few spatterings around the rest of the world for these technologies.
Okay. So I honestly, you guys both made some interesting points here. Now, I was given a question. I was asked a question by a client on Vecima yesterday in regards to the press release. So I actually did get a chance, even before the debate, to take a look at the company's financials. Just so everybody knows, Vecima is a company that has been under coverage in our research in the past. At the time it had good growth in earnings, a low valuation, and a net cash balance sheet. This was years ago. Now, as Brennan mentioned, it's now in a net debt position, not much of a net debt position, still a strong balance sheet, but we have seen the cash fall. And it's, although the balance sheet is still strong, it has become less strong over time. Now, Brett, I don't know if there has been a nice acceleration in earnings growth lately. So in the past couple of years, when I've looked, earnings have been low. The earnings growth has been negative at times. There's been a lack of profitability, but just in recent financial reports, the company has really started to grow their earnings again. It's actually fairly impressive growth in earnings per share in the last quarter. I think it was about 70% or so. Am I correct on that? Yeah.
Yeah.
Okay.
It's somewhere around there.
Yeah. But it's really impressive. The problem is that even with that level of revenue growth, earnings are still pretty low. And, Brennan made maybe one of the best 60 times earnings right now, right? And I liked the press release. It sounded great. 8 out of 12 operators in North America, cable operators, to be in that many major cable operators is a fantastic achievement for the company. But there was really no specific information provided financially on what that means. So one of the things that I was kind of struggling with when I'm looking at that is like a lot of this work that they've already done and it's already in the past financials, or is some of it new sales that is going to drive, greater amount of growth going forward? And the information just wasn't there. Is any of this going to be recurring, or are they one-off? So when I look at the company right now, I see a company that is improving, is exciting, but am I going to buy it right now? No, I'm not going to buy it right now because the earnings per share, they're just not significant enough. They're still relatively low. 60 times earnings for what's, essentially a hardware company. Hardware generally trades at a lower valuation relative to software companies. That's expensive. It's not a net cash business anymore. I have seen this company, exhibit some pretty significant volatility in financial performance. Not so much on the revenue line, but certainly on the profitability line. So while I think you both did a great job, it pains me to say I'm giving this one to Brennan. Brennan's the winner.
It pains you to say? It pains you?
Pains you.
Yeah.
I think it was one on the coin toss there.
I agree.
And what I think that really should be pointed out is Brennan is turning his back on his own city. This company was founded in Saskatoon.
Really?
Yeah.
And
Because they're based out of Victoria now, are they not?
He took the bear case. Yeah, but
so.
founded in Saskatoon.
Yeah.
They're
They're
all
actually
fleeing.
their facility is very close to where I used to live. So
Yes.
yeah, right outside.
Well,
of
Brennan,
Victoria.
And
if
just
you're
to
cool
put it
with
in-
turning your back on your people, that's
Well,
okay.
If it means getting the W.
To get the win, right?
Well, you're
Do
from
it.
Vancouver,
Throw
right?
Saskatoon
Ryan, you're
under
from
the
the Vancouver area.
If it suits me well in the upcoming argument, you're gonna.
Okay, yeah,
you're
because
gonna
there's a
close
lot
it,
of
yeah.
junior mining companies that were founded here in Vancouver. You're not going to turn your back.
I
on
beg
them.
to differ.
No
I beg to
revenue,
differ
no
that,
profit. Ryan invests
I beg to
in them all.
differ that they're actual companies. I don't even include them in my analysis or
Okay.
as a company. If you don't have a shred of revenue in your history, you're not really a business yet.
That's
You're
convenient.
just. Yes.
Which the internet will rip you apart for.
I hope
so.
I'd
Yeah.
love to.
Yeah.
Yeah.
Do you not recall the what was it? The CEO from the TSX Venture tried to call me out on ripping TSX listed mining exploration companies, and that was fun. We
Yeah.
look back to see what the index has done since then. It's been once again impressive performance. Thank you.
If I could
And
just
I just look at the scoreboard is what I tell him.
going back to Vecima, just to put it into perspective for listeners. So when we initially recommended it in June of 2014 and put a buy on the stock, the company had about 5% in revenue growth, had 70% in earnings growth, and was trading at about 14 times forward earnings. So just putting that into perspective and into contrast of,
And
my big
maybe,
W
maybe earnings growth is going to continue to be strong and they're going to grow into this valuation. But I don't have the confidence that that's going to happen.
Yeah.
And, I'm not even 100% sure that earnings growth or maximizing margin or just, doing what you need to do to achieve a stronger margin is really what the main focus of the company is. A lot of times, these technology companies will say, well, we're investing in growth at the expense of profitability. Growth meaning in revenue growth and trying to acquire market share. Sometimes that works out. Sometimes it doesn't. We're looking at the cash flow. We're looking at the profitability. And I have to be honest, because I did look at the company yesterday. I'm very interested in seeing how the company does over the next couple of quarters and how earnings trend. But I wasn't opening up my brokerage account to make any purchases at that point in time.
I will add that's the exact same conclusion. Me and Brennan were actually talking about this yesterday. We were concluding on who was going to win, and I was saying just the valuation was straight up too high. If we were trading at a 10 PE, even a 20, it'd be more respectable. Yeah. But even if the technology is going to succeed, and it looks like it is to me, but if they can't get those margins up, it's going nowhere. I'm not going to pay for 0 cents on the dollar back.
Yeah.
Yeah, exactly. And it's actually, like, you look on just a share return basis, like, it's done quite well this year in a down market for hardware, software, anything to do with technology. So, I mean, they've had good news. I mean, it's likely on the backs of stronger earnings relative for the company, good 60% plus jump in revenues. It's excellent to see. There's certainly worse companies out there, but what price are we paying for the underlying value? And right now it does look to be quite high. So I think that's the conclusion we'd have. Again, this is nothing against the company. It's just us looking at it from a fundamental perspective. Even if they are to continue to grow at this rate, it would still likely be quite pricey right now. And, our watch then will be like what the everybody's been saying on the margin front. And Brennan, you didn't really have to make that point. You already won, right? So you already won, but thanks for making the point there. I think you had that information just, in your quiver, just expecting to lose, and you just wrote more so you could say, but this look. No, you provided a good historical context for where, what multiple the company would have to be with what growth rate for us to actually consider it a buy, right? And it had been trading back at those levels. Stock's done well since then. We happy to see, but I think right now it's a little more on the pricey side.
Late to the party, if anything.
Yeah, at this point, right, for sure. Yeah. Okay, I think that does our show this week, does it not? We're good?
Does it?
We are good. Okay, well, keep rating us or reviewing us, subscribing to YouTube. If you're on just listening to the podcast, rate us and review us on there. And, we'd love to hear your feedback. Keep your questions coming into our Your Stock, Our Take segments. If you've got a company you want us to debate, send it in to us now and we'll answer those questions. Thank everybody for listening and wish you all profitable investing. Thanks.
Profitable investing. Thank you.
Thanks, everyone.
Thank you.